This is the story of how billionaire Eddie Lampert systematically dismantled one of America's most beloved retail giants while legally extracting $6 billion for himself. What happened to Sears wasn't just corporate mismanagement. It was financial engineering disguised as business strategy. For over a century, Sears was the Amazon of its day. The company brought mail-order catalogs to rural America, built the first retail empire, and employed 125,000 people while generating billions in revenue annually. When Eddie Lampert took control in 2005, Sears was valued at $30 billion. 13 years later, it was bankrupt, its workers unemployed, and its creditors left with pennies on the dollar. But here's what makes this story different from typical corporate failures. This wasn't about a changing market or technological disruption catching a company off guard. This was about a hedge fund manager who figured out how to legally strip a company of everything valuable while leaving everyone else holding the bag. Eddie Lampert wasn't your typical retail executive when he gained control of Sears in 2005. He was a Wall Street golden boy, a hedge fund manager who had built his reputation finding undervalued assets and extracting maximum profit from them. His fund, ESL Investments, had generated spectacular returns for investors through aggressive financial strategies that prioritized short-term gains over long-term stability. When Lampert looked at Sears, he didn't see a struggling retailer that needed operational improvements. He saw a collection of valuable assets wrapped in an underperforming business. The company owned some of America's most valuable real estate, prime locations in shopping centers across the country. It owned iconic brands like Craftsman and Die Hard that had decades of consumer loyalty built into them. It had millions of customers and a supply chain that reached every corner of the United States. The traditional approach would have been to invest in modernizing the stores, improving the customer experience, and competing more effectively against rising competitors like Amazon and Target. Instead, Lampert chose a completely different path. The strategy he implemented was breathtakingly simple in its audacity. Since he controlled both the company and the board of directors that approved major decisions, every transaction was technically legal. He would sell Sears' most valuable assets to himself or to third parties at prices that benefited everyone except Sears itself. The numbers tell the story with devastating clarity. Between 2011 and 2014 alone, Sears lost $7.1 billion. But during that same period, Lampert and the entities he controlled were extracting or gaining control of approximately $6 billion in value. These weren't coincidental events happening in parallel. They were directly connected. Consider the Craftsman brand sale in 2017. Craftsman tools had been synonymous with American craftsmanship for nearly a century. The brand had customer loyalty that money can't buy and market recognition that competitors spend billions trying to achieve. Lampert sold this crown jewel to Stanley Black & Decker for $900 million. On the surface, this might seem like smart asset management, selling a valuable brand to raise cash for operations. But here's the crucial detail. Sears was already struggling financially when this sale happened. The company needed that $900 million, but it also needed the ongoing revenue that the Craftsman brand generated. By selling the brand instead of investing in it, Lampert was essentially trading future income for immediate cash that could be extracted from the company. The real estate deals were even more revealing. Sears owned property worth billions of dollars in prime retail locations across America. Instead of leveraging this real estate to improve the business, Lampert orchestrated deals worth $2.6 billion that transferred control of these properties to entities he controlled or influenced. Here's how it worked. Sears would sell its real estate to a separate entity, then lease the same properties back for its operations. This generated immediate cash for the company while creating a new revenue stream for the property owners, who happened to be connected to Lampert's investment empire. The company got short-term cash, but it also locked itself into long-term lease obligations that would drain money from operations for decades. Even smaller brand sales followed the same pattern. The Die Hard battery brand was sold for $200 million to another entity in Lampert's network. Each transaction was structured to extract value from Sears while creating new profit centers for Lampert's other investments. But the asset sales were only part of the strategy. Lampert also used his control of the company to create financial arrangements that benefited his hedge fund at Sears' expense. ESL Investments became a major lender to Sears, charging the struggling retailer interest on loans that kept the company operational. This created a perverse incentive structure where Lampert's fund profited regardless of whether Sears succeeded or failed. When Sears needed cash to pay suppliers or meet payroll, it borrowed from ESL Investments. When it needed to restructure debt or fund operations, it turned to entities controlled by Lampert. Each transaction was approved by a board of directors that Lampert controlled, ensuring that every deal favored his interests over those of other stakeholders. The human cost of this strategy became apparent as the company's operations deteriorated. Stores that had once been flagship locations became shabby and understaffed. Inventory levels dropped as suppliers grew nervous about the company's ability to pay its bills. Customer service suffered as the company cut costs to service its growing debt burden. Employees watched their workplace transform from a proud American institution into a hollow shell of its former self. The 125,000 workers who depended on Sears for their livelihoods found themselves caught in a downward spiral they couldn't control or escape. Store closures accelerated as locations became unprofitable, but the closures weren't necessarily driven by market conditions. They were driven by the company's inability to invest in maintaining competitive operations. By 2018, the inevitable conclusion arrived. Sears Holdings filed for Chapter 11 bankruptcy in October, marking the end of an era in American retail. But even bankruptcy became another opportunity for Lampert to extract value from the situation. In a move that creditors would later challenge in court, Lampert positioned himself to purchase Sears' remaining assets through the bankruptcy process. Having stripped the company of its most valuable properties and brands over the previous decade, he was now in position to acquire what remained at bankruptcy auction prices. The creditors who had extended credit to Sears based on its historical stability and asset base found themselves facing massive losses. Suppliers who had delivered goods expecting payment watched their invoices become worthless paper. Bondholders who had invested in what they believed was a stable retail company discovered that the assets backing their investments had been systematically removed before they could be used to satisfy debts. The legal challenges that followed revealed the full scope of what had happened. A committee representing creditors filed court documents alleging fraudulent transfer of at least $2 billion in assets. Their argument was straightforward. Lampert had intentionally stripped the company of valuable assets while it was insolvent then, positioned himself to profit from purchasing the remaining company at bankruptcy discounted prices. One particularly damning court filing stated that Lampert caused the debtors' bankruptcy by stripping them of their most valuable assets, and then seeks to purchase the debtors' remaining assets for a fraction of their value. The creditors argued that court estimates showed they would recover only pennies on the dollar, while Lampert walked away with billions in extracted value. The legal proceedings highlighted a fundamental question about corporate governance and fiduciary responsibility. When someone controls both a company and the board that's supposed to oversee that company, what protections exist for other stakeholders? The Sears case demonstrated that existing legal frameworks allow for asset extraction strategies that are technically legal but economically devastating for everyone except the person implementing them. What makes this story particularly troubling is how it represents a broader trend in American business. The strategy Lampert used, buying undervalued companies, extracting their most valuable assets, then walking away when the remaining shell becomes unprofitable, has become increasingly common in the era of private equity and hedge fund dominance. The difference with Sears was the scale and the audacity. This wasn't a small company or an obscure brand. This was an American institution that had survived the Great Depression, 2 world wars, and decades of changing retail markets. It had weathered competition from discount retailers, big box stores, and the early days of e-commerce. What it couldn't survive was being systematically dismantled by its own leadership. The employees who lost their jobs, the creditors who lost their investments, and the communities that lost their anchor stores all paid the price for a financial strategy that prioritized extraction over operation. Meanwhile, Lampert and his investment entities walked away with approximately $6 billion in value that had been built over more than a century of American commerce. This wasn't just the failure of one company. It was a demonstration of how modern financial engineering can be used to legally dismantle even the most established businesses while enriching the people responsible for the destruction. The $6 billion that Eddie Lampert extracted from Sears represents more than money. It represents the systematic conversion of American industrial heritage into private wealth, leaving nothing but empty storefronts and unemployed workers in its wake. The Sears story serves as a warning about what happens when financial engineering replaces business strategy, and when extraction becomes more profitable than operation. It's a cautionary tale about the need for stronger protections for stakeholders when companies face systematic asset stripping disguised as corporate restructuring.